Hey everyone, welcome to today's ICT Concepts walkthrough. Today we will be talking a bit more about gaps, revisiting fair value gaps and showing some of its more special forms. Then we will also be talking about other types of gaps, namely new day opening gap, new week opening gap, and opening range gap. Gaps in the context of ICT concepts are areas where either there was little to no trade happening or trade being done inefficiently in a one-sided manner. Fundamentally, the market is about moving to and from areas of liquidity, and gaps are a form of liquidity. Using the analogy of animal tracks, gaps are places where the market has left signs, and understanding these signs puts you in a situation where you can predict what the market will do. The most common and well-known gap is the fair value gap. I've already gone through fair value gaps in one of my previous videos, so I won't go in depth into it. But in short, fair value gaps is a type of trade that is one-sided, meaning that buyers and sellers could not efficiently trade. So fundamentally, there are two kinds of gaps. One which is formed by a rising candle, which is called a bullish fair value gap, and is named as such because buyers could not efficiently trade, and will offer fair value for future buyers to retrade in this area. Consequently, a gap formed by a descending candle is called a bearish fair value gap and will offer fair value for future sellers. Another type of gap is called a volume imbalance. This is a two-candlestick pattern where there was either no trading at all between the two candles, seen to the left, or when there was trading, but only with the wicks and not the candle bodies, which can be seen to the right. A volume imbalance without the wicks is a true gap, so-called liquidity void. One thing to note about this type of gap is that if they form together with a fair value gap, then the fair value gap should be extended to include the volume imbalance. Like fair value gaps, volume imbalances are places where either no trade was done or it was done inefficiently. So the market tend to draw to these areas and show some reaction to it. Either they are used as support or resistance, or it will trade through them and use them as a leverage to get to somewhere else. As always, not all volume imbalances are significant and they need to be seen in a greater context. Observe the preciseness of the last couple of ticks. This shows that the algorithms truly are aware of the volume imbalance. But as for fair value gaps, you cannot just blindly follow volume imbalance, but rather, they have to fit in your narrative of where the market is headed. The next type of ICT gap that I like to put on my charts is the new day and week opening gap. This kind of gap is a bit more subtle as it is not readily visible on the charts. Instead, it is based on the fact that the market is closed between certain hours of the evening and weekend, and that makes it a true liquidity void, as no trading can be done during that time. The new day opening gap is formed by the last candle bodies close before 5 p.m. as marked on the above chart, and by the 6 p.m. candle bodies open. I like to draw dotted lines marking these levels, and give it a label for the following day that it is in effect. In this case, it formed on Thursday evening, so I will mark it as new day opening gap Friday. Similarly, new week opening gaps are formed by the close of the last candle on Friday, just before 5 p.m., and the open of the first candle on Sunday at 6 p.m. Since these gaps are liquidity voids, I tend to think of them like bookmarks, where the market keeps track on where they are and often return to them and then pivot in either direction. Sometimes, for wide gaps, it can also be useful to keep track of the midpoint of the gap. ICT says that it is good to keep up to 5 days old new day opening gaps and up to 5 weeks old new week opening gaps. I personally have found these kind of gaps useful, either in the absence of any other liquidity voids or imbalances or in conjunction with them. Opening range is the range of trading high to low for the first 30 minutes of trading between market open at 9:30 to 10 a.m. This range of trading is often significant as, later on, the market tend to revisit them. However, it is not a gap. Although this is something ICT talks about, it is not to be confused with opening range gap. Opening range gap is the range from the previous day's market close to the next day market open. The easiest way to capture this area is to switch from electronic trading hours to regular trading hours. Then the gap becomes more apparent and you can draw a box from the previous day's candle close to the current day's candle open. And here you can see the opening range gap in orange and the opening range in the green. As we will see in the next example, the midpoint of the opening range gap is particularly significant. In this example, we are going to see three different gaps in play. First, we are going to make sure that regular trading hours is displayed, and then we will highlight the opening range gap. This is done by drawing an orange box from previous day's close to today's market open. Then we will switch back to electronic trading hours and observe what happens. Observe these two red lines, which are two liquidity targets ready to be swept. And also notice the Friday's new day opening gap. Further notice how the opening candle form a bullish fair value gap. Then watch how the market trades down to this area. Look at the precisement on how those three candles both balance out the fair value gap as well as going down to the midpoint of the opening range gap. And as a bonus, revisiting the new day opening gap. It is these kind of signs which give a strong signal that something is about to happen. In this case, going up to swipe these two liquidity levels. It is basically the market showing its hand to us. And that is it for this time. As always, I hope you found it helpful and may it help you to get many profitable trades in the future. And I will see you the next time.